And now let's make some money. So far we've seen that we've set up the business. In February we'll actually start making some revenue. Let's imagine that my business actually has to do with going out and doing consulting. I've got my little jalopy car here and I'll show up and spend an hour with you and you'll give me some cash. So I agree to go out and do $100 worth of consulting. So let's set up the accounts as they exist right now. I have my trial balance here. I see that I have $14,000 cash. I have a vehicle which is worth $1,000, or I purchased for $1,000. I have my notes payable. I owe the bank $10,000, and I have paid in capital of $5,000. In February, I go out and do some consulting. Somebody pays me $100. They put $100 into my hot little hands. So my cash goes up by $100 by just using the accounts that I have on the board right now. That $100, who has claim to it? I have claim to it. Paid in capital, it's an equity account. I could increase that. It's certainly not a liability. Somebody else doesn't have claim to that $100. I've earned $100. And good. I put it into paid in capital. A week later, I receive my electric bill. It's $50. I write a check for $50 and send it to the electric company. That has decreased cash. Remember, I decrease cash with a credit. What am I going to debit that's on this board? Actually, the company has shrunk a little bit and my claims have shrunk. So I'm going to debit paid in capital. If this were 400 years ago, these would be all of the accounts that I would have as an accountant to take a look at this transaction. But as time went on, people wanted to know, well, if I want to know how much I'm making during the year, I would have to go through and pick out all of these credits that go into paid in capital. And if I wanted to look at my different expenses, I'd have to go out and pick out all of these little debits, and then I'd have to summarize those according to were they utility payments, were they entertainment expenses, were they salaries. So this became inefficient. And accountants developed additional types of accounts to take care of this. They created income accounts and expense accounts. So let me back up a second here, and for a moment we'll forget that we made any money or spent any money. And I will actually set up an account called consulting revenue. This account behaves like equity. In fact, an income ultimately increases my equity. I will also create an expense account. So here is a utility expense. Ultimately, that decreases owner's equity. So income accounts and expense accounts behave like equity. An income account will ultimately increase equity. So when I increase an income account, I credit it. An expense account will ultimately decrease equity. So when I increase an expense account, I debit it. So watch what happens when I go out and earn $100. I go out and somebody pays me $100 for consulting. I debit cash for $100. What do I credit? I have an income account. I credit consulting revenue. I credit it because it behaves like an equity account. I pay the expense of my electricity. That ultimately decreases cash. So I'm going to decrease cash, doesn't ultimately, I mean immediately decreases cash. So I'm going to decrease cash $50, and I am going to debit utilities expense. Because this is an expense account, it behaves like equity. I debit it, which will ultimately bring down equity. Now I'm going to show you one thing, however, that's important. You saw that I first credited cash and I debited utilities expense. Accounting etiquette says that we must first do our debits and then our credits. Or at least when we're talking about a transaction, we say our debits first and then our credits. Because people are listening for the debits first. So if I were to do that transaction according to accounting etiquette, I would debit utilities expense and credit cash, $50. Now, if I'm looking at my trial balance, you'll see that some things have changed here. My cash balance is now $14,050. My vehicle is still $1,000. My notes payable is there. I have my utilities expense and my consulting revenue and my paid-in capital. So if I were to take a look at my trial balance, my cash balance would be $14,050. Nothing else has changed, but I've added 2 accounts. I have my consulting revenue, and that has been a credit of $100. And I have my utilities expense, which is a debit of $50. Am I still in balance? Well, looks like I have $14,100, $15,100 of debits and $15,100 of credits. That at least tells me that yes, in fact, my debits equal my credits. And we'll take a look at where we've ended here in our next segment, where we talk about another financial statement, the income statement.